everybody, and welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I'm your host, Denny Troncoso, and I'm glad you are listening in. If you haven't already, make sure to subscribe and like us on iTunes or your favorite app. In this episode, we have an expert on self-directed account investing with us. This is a different way to invest funds that are inside a retirement account. Not only does this company help you with staying compliant while investing with an account that's self-directed, but our host actually believes in doing what he preaches. He actually drinks his own Kool-Aid, which is great to hear. Now, we discuss great information on the call, so stay focused and make sure to have a paper and pencil to take notes. Now, Desiree did get me sick, so I'm feeling a little under the weather on the call, so bear with me. Now, let's get to the call. Hello, everyone, and thanks for being on the call. Today I have Jason Debono, who is the Vice President of Nuview IRA. They are a IRA custodian located in Central Florida. And Jason's a graduate of the University of Central Florida, which is fantastic to me. He's a fellow Knight. And he holds a Certified IRA Service Professional designation from the Institute of Certified Bankers. He's a guest speaker for tons of different organizations regarding the topic, the very specialized topic of self-directed IRAs. And he's very active in the community through volunteering, Big Brothers, Big Sisters, and also Wheelchair Association. So without further ado, Jason, are you there?
Yeah. Hey, Denny. Thanks for having me.
Hey, no, glad to have you. So tell us a little bit about yourself, Jason, and how your background a little bit. How did you get into self-directed IRAs?
Well, it's kind of an interesting story. I've been in this business going on 14 years now, and I started back when kind of the industry was still relatively young and pretty well unknown. And its origins go all the way back to graduating at UCF. I was wrapping up my last semester of college and looking for an internship to gain some experience beyond the retail job that I had carried through college, and went to an internship expo that UCF had hosted. And I came across quite a few companies, most of them household names that were there to recruit college kids. And I stumbled upon a company that I didn't know what they did or recognized, and had a great meeting with the founder of the company, Glenn Mather, and ended up interviewing. And, long story short, what caused me to accept that position versus some of the other more household names that I had encountered was really my dad's reaction when I called him after the interview and said, hey, Dad, did you know you could buy real estate and other investments with retirement money? And, my dad said, no, you can't do that. My brokers told me that that's not permissible. And obviously, as a college kid, I was certainly happy to know something that Dad didn't, and I made every opportunity to make sure that I could poke at him a little bit for having knowledge he didn't, and he was so excited about it, and he said, "Gosh, I wish I'd have known about this 10 years ago." And I kind of realized at that point, hey, if I'm going to really learn and grow, we've got this kind of new and up and coming company, and getting in on the ground floor and having an ability to go out and reach the marketplace of people just like my dad, who aren't necessarily full-time investors, but have always bought and sold some real estate, and being able to take advantage of that in their retirement account versus being forced into the stock market seemed like an attractive opportunity. And here we are 14 years later, and still telling the same story about how it's possible to use your IRA in ways that your broker won't tell you about.
Excellent. And I think that's an interesting story because your dad wasn't exposed to it. And not only that, but he was, they talked basically down on self-directed IRA investing, it sounds like. Is that right?
Yeah. And, thankfully over the last 10 to 15 years, that's really changed as it's become more mainstream. But certainly, the availability, accessibility, and understanding of self-directing a retirement account into something outside the stock market, even just 10 years ago, was really hard to understand and find any kind of information about.
Got it. Okay, well, let's jump right to it. So what is a self-directed account? IRA, 401k, Coverdell, they could all be self-directed, but what is the self-directed part? What's the definition of that?
So, self-direction is kind of a general term, and really in today's world, it's used in a lot of different manners. When we use the term self-direction, it really means two things. It means all the choices are made by the account owner. That's the self and self-direction. And the second part of self-direction, and probably more so the most important, is that the investments that are available to your account are not limited by the custodian holding it. So I'll kind of give you an example. If you were to go to, some of the clearing firms today, Schwab, Fidelity, they're all starting to offer, quote unquote, self-directed accounts. And while that first part is true, you get to pick your investments. The part that's lacking is the custodian still has limitations. So they're only going to let you self-direct into a stock, bond, or mutual fund or publicly traded asset on their platform. A fully self-directed account or a true self-directed account through an alternative asset custodian like Nuview doesn't have those limitations. So not only are you able to pick your own investments, but you get to pick from really a menu that includes everything, as long as it's not life insurance or collectible as prohibited by the IRS. It's permissible within a self-directed account, as long as your custodian doesn't add those restrictions. And that's where self-directed custodians like Nuview come into play.
Got it. So basically what you're saying is I could take the IRA that I had that I opened at a local bank, or the money that I transferred over from my 401k or being self-employed. Now, I could take that and put it in an account with Nuview, and then I could invest in different types of investments, like gold, for instance, real estate, and stocks and bonds too.
You got it. And so what we do is we hold IRAs just like a bank or a brokerage firm such as Fidelity or Schwab do. So from that standpoint, we're identical. We all produce the same level of reporting to the IRS, and we all have the same type of regulations and regulatory environment that we operate within. What makes us different is the type of investments we hold. So in our case, as an alternative custodian, we don't have custodial limitations beyond what the IRS puts out. So that means that your IRA, being fully self-directed, can invest into anything non-publicly traded, such as real estate or precious metals or private loans or private placement investments or non-publicly traded companies, as well as stocks and bonds, albeit that's really one of the smallest asset classes that we hold, simply because if your desire is to hold publicly traded securities, you have so many options today to do that. People come to us because they want to hold investments that the primary institutions that hold retirement accounts aren't willing to hold, and that's really everything outside of the publicly traded market.
Okay. Basically what they also call alternatives. Would that be a good
You got it.
word? Perfect.
Absolutely.
So what are the benefits of using a self-directed account versus going at it with, let's say, cash, for instance?
So there's really two ways to look at kind of the benefits of a self-directed account. So the first benefit is kind of what our tagline refers to as more choices, more control. So before we compare it to personal money, let's just compare it to the alternative of what else that IRA can do. So as it stands today, you've got X amount of dollars sitting in an IRA account at any other institution. You only have access to what's on their platform. And so for someone like you, Denny, and lots of people that are listening in, their knowledge and expertise and understanding of investments goes probably far more into alternative investments such as real estate than it does about stocks and bonds. So again, whether it be yourself or anyone similar, you spend a lot of time in the real estate market. You attend, a significant amount of training. You work in that market every day. I think it's fair to say that your knowledge and expertise of the real estate market is significantly higher than it is of that, like stocks and bonds. And so what self-direction gives someone like you is the ability to invest your retirement money, which has to be invested somewhere. It gives you the ability to invest it in what you know and understand. And hopefully that knowledge and experience can lead to better returns. And that's really the primary benefit of why people move funds from a stock-based, retirement account into an account with us to go access investments that they're knowledgeable. And there's other people that are more knowledgeable about precious metals, or other people that are more knowledgeable about private investments or private lending or any of those items, and all of those become accessible. So the first benefit when comparing it to your retirement account is it's got to be invested. You might as well invest it into what you know and understand.
Okay.
When you compare it to your personal money, if you've got the ability to, let's say, buy a piece of real estate, you could buy it with your retirement money or your personal money, then you've got to look past the knowledge and experience because you've already chosen the investment. Now you're really focused less on the investment and more on the vehicle. And the biggest benefit that IRAs, especially the Roth, can provide is they can provide a tax haven to make that investment. So while real estate can provide depreciation and other things, any income is still going to hit your tax return and can and likely will create tax liability. If you make that same investment through a retirement account, because an IRA is already by nature a tax-deferred arrangement, or in the case of a Roth, a tax-free arrangement, all of the profits generated, whether it be rental proceeds or sale proceeds, into that IRA account all come in tax-free on a transactional basis, and in the case of a Roth, are never taxed. So there can be some significant tax advantages to making these purchases, especially things like real estate inside an IRA versus with your personal money.
That is so powerful. The power of saving the money to either to avoid the tax completely legally, or to delay it with the tax deferred accounts, which allows you just to grow so much bigger account, because you can delay the tax to a later age. And you mentioned Roth accounts. You mentioned the traditional IRA. You can use both of those, which are typically retirement accounts for individuals retiring after age 59 and a half. And what about Coverdell accounts, health savings accounts? You can use those too?
Yeah, and you bring up something that I think is one of the coolest parts about self-direction, and really something that a lot of savers don't really take a look at and don't really understand. That a lot of times people think their approach to saving for retirement is kind of a one and done, right? Pick an account, stick with it, and put money into it. And what's really nice is there's lots of different accounts based on how you earn money, and there's lots of different ways to save. In some cases, you can save across multiple accounts, giving you the ability to save more for different reasons. So most people fund their retirement savings through 401k, and that's a phenomenal program for those that qualify. If you're ever covered under an eligible 401k or 403b, 457 thrift savings plan, kind of these employer-based plans, without a doubt, you should always take advantage of those at a minimum up to the amount that your employer is willing to match. But once you go outside of 401ks, whether you're being self-employed or whether your employer doesn't offer it, you've got the two accounts that we mentioned, both the traditional, which is the pre-taxed approach to saving, and the Roth, which is the post-tax, meaning you pay the tax up front and you have tax-free withdrawals. But there's a couple other plans that exist. One is a simple IRA, and that's really for small employers, less than 100 employees. It's really a 401k light. It's an IRA program, but it gives maybe a 5 or 6 person company the ability to save under a similar plan to a 401k without a lot of the same cost. And then the plan that I really like for those that are self-employed is the SEP IRA, which gives you the ability to contribute up to 25% of your self-employed earnings. And then to go a step beyond the SEP, there's a plan called an individual or solo 401k, which gives individuals that are self-employed with no common law employees the ability to save like an employee and an employer. So they can put away up to $18,000 or $18,500, I believe, in 2019 as a 401k employee contribution. And then they can also match their own contributions as the employer of another 25%. So it really allows accelerated contributions into this plan. It also allows for the employee deferral of $18,500 to go directly into a Roth. So you can take advantage of a higher contribution limit into the Roth account. So those are your savings plans from an employment standpoint. What's really cool is there are two kind of bonus plans that I like to refer to them as, and that is the Coverdell ESA account, also referred to as a CISA. And that account is great because it allows you to save for a minor's education. There's no tax deduction to contribute. However, all of the growth inside that account is tax-free for qualifying educational expenses. And then you have the health savings account for those that have a high deductible health program or high deductible health insurance. They've enacted a savings component that allows you to save into those health savings accounts. And what's really cool about HSAs is you get a tax deduction for the contribution and you get tax-free distributions for qualifying medical expenses, which is really the best of both worlds between pre-tax and Roth accounts. And that's certainly something that people can and should, if they qualify, be taking full advantage of. And kind of to put a bow on it all of the accounts I mentioned can be self-directed. So to use myself as an example, I have my 401k through Nuview, which I self-direct. I have an HSA account, and we have a 7-year-old. I have an ESA account for Tyler, our son, which we also contribute to and self-direct. And so all three of those accounts can go out and participate in alternative investments. And what's really cool is they can participate right alongside each other, which is a major benefit.
That's awesome. And that all those accounts that you can use to self-direct and then choose specific investments for each account. And I know we're gonna talk a little bit about the investments later, but I know that there's some rules with the accounts that you have to follow to make sure that you're in compliance with the IRS and the government. Can you talk a little bit about that? I think there's you talked a little bit about some restricted investments, and then also there's parties that you can't do business with, et cetera.
Yeah, and obviously we've been talking about all the benefits, and certainly we want to make sure that we at least address the rules. And I mentioned earlier that there really are no custodial limitations in an account with Nuview other than what the IRS sets forth in terms of prohibited transactions. And it's really a two-part rule that you need to be aware of when engaging in a transaction to determine if it's permissible. I mentioned already, and I'll repeat it again, kind of part one of those has to do with what you invest into. And that really boils down to no life insurance and no collectibles. So as long as you steer clear of those two asset classes, as a general rule, and there's a couple other exceptions, your IRA can make an investment outside of those two asset classes. Rule number 2 doesn't really take into account the asset class. What it does is it takes into account the investment in the parties that are engaged in that investment. And the IRS, for their enforcement around the rules, declare that your IRA can never engage with what they consider a prohibited or disqualified party. Now, I didn't create this list, nor am I responsible to enforce it, so please don't shoot the messenger. But the IRS does not allow a transaction between an IRA to occur with the IRA owner, the spouse of the IRA owner, any parents or grandparents of that IRA owner, children and grandchildren of the IRA owner, as well as by extension, any spouses or businesses owned or operated by any of the parties that we just mentioned. And the ideology behind it and the reason those rules were put into place is to ensure that people aren't using the tax advantage status of an IRA to engage in some sort of sweetheart deal. So I use my dad, for example, as being excited about self-direction. He's, been an account holder for many, many years. And in his account, he is prohibited from doing business with me personally. So he could never lend money out of his IRA to me or invest his IRA into my deal. And the reason for that is the IRS is fairly confident that there would likely be some sort of sweetheart terms if there were no prohibitions. So, for example, my dad may want to get some money out of his IRA so he could just loan it to me at a significant discount. And that would be the equivalent of getting it outside the IRA without there being tax consequences or penalties. And so the IRS says, hey, we're not going to police whether or not these deals any deals between these parties that are considered prohibited. We're not even going to police whether they're at fair market value or not. We're just simply going to prohibit it, period. So the key thing is you want to make sure your transactions don't involve a prohibited or disqualified party, and you want to make sure that at an arm's length. And what that simply means is that the relationship of the parties doesn't have any involvement or any sort of sweetheart dealings to the terms. Does that make sense, Denny, or kind of, give some clarity?
Yeah, it makes sense. You're basically keeping people honest, or what the IRS is doing. So if my father, he can't lend to me if I'm buying a property, because my father, instead of charging me 10% interest, which is the market rate, maybe my father says, Denny, I'll give it to you for 5% because you're my son. And they want to keep the IRA separate. Am I understanding that correctly?
Yeah, and that's a great example, and that's exactly right. And so, if you kind of look at it at face value and really compare it to what your IRA is doing today, those rules apply in the market as well. We may not realize it, and we don't see it because, we're investing into these big publicly traded companies, but those same rules apply. And if you kind of think about your IRA today, if you're invested into publicly traded, stocks, bonds, and mutual funds, there's zero personal benefit that you gain, and there's zero personal benefit that your family gains from any of those investments. Right? You've bought them with the hope and expectation that they go up in value, and your investments by buying alternatives have to follow that same logic. Just because you can pick your investments, the IRS still requires that you pick true investments that aren't related to people that you know. Because at the end of the day, is it really an investment in the best interest of the plan for your dad to loan you money at a severe discount? No. And the answer to that is no, right? It benefits you as his child, not your dad's account. And that's what they want to make sure it doesn't get violated.
Of course. I actually remember, as you're talking about this, when I was process of purchasing a multifamily property, and had everything lined up, ready to go, and coincidentally, how fate happens, my father-in-law was going to be one of my investors, and we were getting married like a week before the closing, and we did. And come to find out, I contacted you, and for some reason we chatted, and you said, "Well, Denny, you're buying this property. Well, that's going to be a prohibited, transaction because you're supposed to be a disqualified party." And by having that conversation with you, it prevented to put his IRA at risk. So if you violate the rules, the person's IRA could lose their tax deferred or tax free status. Is that right?
Absolutely. And Nuview or any other custodian, we don't take responsibility to ensure you don't engage in transactions. And it's not that we don't want to be part of the process. However, we don't always know the life of the transaction and all the things that occur. So, we encourage, and I applaud you, Denny, in before any transaction, you always give us a call and talk through it and get our feedback. And while we won't provide you necessarily advice, we can certainly tell you, hey, based on what you've told me, this looks like it could be an issue. You may want to seek some counsel. And, we encourage all our clients to do that because ultimately, if you direct us to make an investment and we don't know that you're investing into a company that your dad owns, we'd have no real way of knowing that. You do put your IRA at risk. And in the event of an audit, if the IRS sees, like in your example, that the lender on your personal deal was a disqualified party, they're going to disqualify that account. And it can be a very expensive undertaking because they're going to disqualify it all the way back to the day the investment occurred. There's going to be penalties. They're going to force the account to be distributed. So taxes and penalties will apply, as well as penalties from the time of the distribution all the way to current. So it's a hornet's nest you really want to stay away from. And as attractive, as it is for both parties to engage in these types of transactions that violate the rules, it's not attractive enough when you understand the risk. Mm-hmm. And we sincerely hope our clients view this as an opportunity really to get outside the stock market, not an opportunity for them to get their IRA into their own hands or the hands of very close family members, as that's not the purpose of self-direction.
Yeah, that was a lesson learned, to make sure to have extra capital lined up in case of an emergency last minute. And that was something that we stayed out of trouble, and we had to scramble in the last few days. But I'm glad we did and kept my father-in-law's account safe and protected, because we even talked to counsel, and it was they just said the same thing. It's just you're basically you're in a situation, you're going to place the account at risk. So with that, let's jump into some of the other rules. And I know they can get a little bit of technical, so you don't have to go so deep on them, but at least to mention them so people are aware. And the first one is called UBIT, which is, I believe, your unrelated business income tax that goes with IRAs or self-directed accounts.
Yeah, so I'll touch a little bit on UBIT, and you're right, Denny. It certainly can get technical, and we'll keep this at about 30,000 feet. And certainly, we've got a full team of people here in the office. If anyone listening wants to dig a little bit deeper into kind of the rules and regulations around UBIT, and really UBIT and UBIT has a cousin called UDFI, and they're two very similar taxes that apply. And before I hit the tax, I kind of want to touch on the scenarios in which they apply. So one of the things we'll start with UDFI, and this is the most common thing we see inside retirement accounts from a tax perspective. And I mentioned earlier the tax arrangement and benefits of self-directing, but I want to make sure everyone understands there are a couple very rare but not impossible scenarios where tax can apply inside the IRA. And I will tell you, if there's ever such thing as a tax that's okay, this is certainly one of those things, because it's really a tax that's the result of making money, and it's the result of making money beyond the IRA's capacity. And so the UDFI tax works just like UBIT, but UDFI is specific to debt-financed real estate. So one of the things that's permissible inside an IRA for real estate is the ability to go out and actually buy real estate with a loan. Now, the loan that you obtain in an IRA is different than the loan you would obtain personally. So if you were to go out to a bank to buy a house yourself, you can offer them and promise to repay that loan on behalf of your personal investment. In an IRA, the IRA doesn't have the ability to personally guarantee a loan, and the IRS doesn't allow you as the IRA owner to personally guarantee a loan on behalf of your IRA. So an IRA, if it's going to use a loan to buy a piece of real estate, must obtain a non-recourse loan. And that is a loan that banks do offer. They're common loans that do exist in the commercial world, and we know of a good handful of lenders that write these loans nationally for residential real estate as well. But a non-recourse loan basically means the IRA is buying the property, making the down payment. The bank is loaning the money to the IRA, and it's loaning the money without any recourse beyond that monthly payment requirement and the guarantee of the property as collateral. So in the event that the IRA fails to make the payments and the bank forecloses, the only thing the bank can do is foreclose on the property. The bank cannot go out and seek a personal judgment against the IRA or the IRA owner. So it's actually a very good loan to have, because it doesn't put you at risk beyond the money that's invested in the property that the IRA is buying. But the IRS says if you're going to engage in a non-recourse loan, then you're really buying this property and generating profits in the IRA with money that didn't originate in the IRA. So the way that this tax can work, and again, it doesn't always apply, is specific to owning real estate with a non-recourse mortgage. But the way that the tax would apply is your profits, and we're talking only profits after write-offs and depreciation and other things, but net profits are only subject to tax in the prorated percentage as they were leveraged. So to kind of illustrate that, if you put 40% down on a piece of real estate and you borrowed through a non-recourse loan 60% for the IRA to make that purchase, 60% of your net proceeds may be subject to tax inside the account. So it's not on your personal tax return. It's a separate tax that the IRA would pay. So it's not going to come out of your pocket. It's just going to come out of a piece of the proceeds. So to use some simple numbers, if you were to make a $10,000, whether that be annual income or profits of sale, it really doesn't matter. 60% of that, or $6,000, is subject to the tax. And so that tax would be paid, and I'm making this number up, but if the tax was $1,000 or $1,500, that would be paid out of those proceeds. So you had a $10,000 return, $1,500 of that went to the tax, and $8,500 goes right back into the IRA, and now that's money that can continue to be reinvested. So it's not a scary tax. It's just a tax you need to be aware of. And so UBIT and UDFI, they're not penalties. They're simply a tax paid to go beyond the value of the IRA. And so you're getting the power of leverage, and for that you're paying a small tax. Does that kind of give you some insight there? And if there's anything I can clarify more, Denny, certainly let me know.
No, sure. I think that that explains it very well. And the UDFI and the UBIT. One thing you did mention also was the recourse portion, and I had a question about that. The IRA holder cannot sign recourse for the IRA, but what happens when if you take your IRA and then you become a passive investor? Can the manager of the investment that you're participating in, if it's a different company, can they sign recourse? Is that something that is allowed?
Yeah, and that's a great question. So the rules around recourse only apply to the IRA owner or any disqualified parties. So if, let's just say, Denny, my IRA was going to make an investment with you, and you were you're the investment sponsor on a deal. Because we're unrelated, you're not a disqualified party to my IRA. My IRA can, number one, make an investment with you. And number two, if you chose to go out and obtain financing that did have recourse, as long as there's no recourse beyond my IRA to me, there's no issues with that investment. So you can always be on the hook, or any other party in the deal that's not disqualified can sign personal recourse. The only non-recourse issue applies to the owner of the IRA invested in that deal, or owners.
Got it. That makes a lot of sense.
And something to note on that, Denny, is the UDFI tax will still apply because my IRA is still generating return off of that leverage. So I'm getting the benefit of increased returns into my IRA because it's a leveraged investment. So I still have the UDFI tax, even though the loan technically is not directly to my IRA, but because my IRA is invested into this deal or offering that does have recourse, the tax still applies, but the recourse simply applies to you as a non-disqualified party, and all of that is permissible inside the account.
Excellent. And I know that you're going to be sharing some information on how people can get more information with you, but I'd also like to share, there's a book that's called Keep It, that I've read, and it had a very enlightening, and it's called Advanced Strategies for Tax Strategies for IRAs by Joe Luby. And that's something that if you're looking to learn more about UDFI and UBIT, they have some good examples in there that I'd recommend. I don't know if have you ever heard of the book or Joe Luby?
I have, and one of the things that's really nice is that I've gotten to kind of see in this business over the last 14 years is the amount of information and accessibility to information about self-direction and the rules and how to stay within the confines has significantly increased. And there's a lot of great books, and the one you referenced is certainly a good one. And there's a lot of people a whole lot smarter than me out there that have taken the time to put onto paper some of the more technical things to be aware of, because self-direction, can be the least technical or most technical strategy, depending on what you invest into and how deep and aggressive you want to get in your investments. And for those that are looking to take advantage of some of the more aggressive investments, or things that can be a little bit more aggressive in terms of getting closer to the IRS rules, then I would actively encourage you to go out and find a resource like Keep It or the like, and really take the time to educate yourself, because as they say, ignorance is no excuse to violate the rules. Mm-hmm. And you want to make sure, ignorance is bliss, and the good news is ignorance is curable. And we live in a world today where, the accessibility of information is at our fingertips. And whether it be someone, a professional like you, Denny, that's taken the time to really understand and study this stuff that can point people in the direction, or whether it's a firm like Nuview, that has a full-blown business and operation that services these types of customers. Ask the questions, be curious, and make sure that you're seeking all the resources available to you to really know and understand what you're engaging into before making the investment, as evidenced by you having that discussion with Nuview as a custodian before you went off and made an investment with your father-in-law's account that could have caused you some real problems.
Mm-hmm. That's right. And I will say, just adding there, that you don't have to know how everything about a car works to drive a car, but I think understanding some of the basics, but those people that do want to know more, those engineer personality types that they want to dig deeper. That's definitely an opportunity, or by contacting your company. Now, so going into that, can you tell us, you've already mentioned what you do as a custodian, but can you talk about some of the benefits and support for working with Nuview, or even some recommendations for finding a quality custodian?
Sure. So, there's a lot of great companies out there that do what we do, and that's really positive for everyone listening that is a consumer. A couple of things to note. I mean, Nuview, we're a fully regulated trust company, so that is something that you want to always look at, is to make sure that the company that you're doing business with is a fully regulated custodian of the accounts, and not everybody in the business is, and just because they're not a custodian doesn't mean that they can't be a safe and good firm to work with. You just want to make sure. The second thing is stability and longevity. There's something to be said. It's kind of like a doctor, right? I don't want to be my doctor's first patient, as a general rule. So, you want to understand how long they've been in business. Nuview's been at this going on 16 years. We service $1.2 billion of assets that we provide custody and administration services to. So the benefit that you get in dealing with a company that has some experience is really being able to ask questions, and they've been able to see enough transactions to at least provide you some, good information. And I think the last thing that's important when measuring a custodian is really understanding their service model, because at the end of the day, you're going to be doing business with them, and you're going to have interactions with them, and you want to deal with a company. Once you've determined that they're safe and secure and well regulated, you want to do business with a company that can serve you the ways you want to be served. So, what does their technology platform look like? Can you make your investments through a portal? Can you log on? Can you get your balances? Can you generate activities, or is everything got to be done with paper and over the phone? The next thing is, what's their service level agreement? What does it mean when you call their office? Is it a big call center? Are you going to be on hold for 45 minutes before you get a live person? And, I always recommend, before you ever do business, this is kind of a, something that I've learned over the years, is you never judge a company by their sales team, because salespeople always answer the phone. So, call the sales team, get acclimated and get comfortable. But then before you decide to do business, and this is true for us or any company, and it really doesn't even beyond just self-direction, dial in and press a couple prompts that take you to customer service folks. And that's the real test of how well they answer their phones and how well they service their customers. And if you're on hold for 10, 15, 20 minutes, you're going to realize that life with this company may not be what you thought it was, because life with the sales team was quick. They picked up, they were very responsive. So, those are all things that we think that we're best in class in the marketplace on. But certainly those are things that before you make any selection, whether it be Nuview or anyone else, that I would encourage you to actively check and validate for yourself before engaging to have a relationship, because it should be a long-term relationship, and there should be lots of interactions as you're, have this account and becoming more active.
Excellent. That's good advice. And I like what you said, never judge it by the sales team. Always, call the customer service department to see if they're answering the phone, and also the quality of the service of the people answering the phone, because sometimes they're not even trained. Can't even
Absolutely.
answer. So can you share some stories on some Nuview clients of some of the investments that they're participating in or investing in?
Sure. This is kind of the funnest part of what I do every day is, I sign off on a lot of investments as the authorized signer for the company. And I get to see, the creativity and uniqueness of what our clients do. And, the beauty is they didn't rely on us for advice, because we don't provide it. These are all investments people have gone out and they've done their own due diligence and they've used their own knowledge and expertise. And, it's really satisfying when I see clients make investments that they're, incredibly excited about, and even more so when those do turn out the way they thought and they can generate, really nice and substantial returns. And all because they took the initiative to go make their own choices. We see a little bit of everything. I think what we do really, if it falls into three primary camps, which would be the most popular investments that our clients make. Those in no particular order are real estate. And when I say real estate, this would be direct ownership of real estate of any kind. So this includes, raw land, residential, single family, multifamily, commercial. We've got clients that own real estate that have billboards on it. We've got clients that have bought and acquired real estate through tax lien and tax deed sales and foreclosure auctions. So if you can, get ownership to it in any, way, shape, or form, we probably have clients that have done it, including international properties as well. So that's kind of a cool thing to see in the different strategies as it relates to real estate. The second category would be private lending. So we see a lot of notes and mortgages, some unsecured, which obviously comes at a lot of risk to the IRA, and then a lot of investments secured by a variety of assets as collateral. So we see real estate as kind of the most common collateral, but we see lots of loans that are collateralized by shares of businesses or investments into businesses. We've seen loans secured by liquor licenses. We've seen loans secured by, farm equipment and crop. We've seen all kinds of pretty cool stuff. And again, it's really speaks to the creativity of our clients.
Yeah, that sounds like a lot of fun. A lot of people doing creative things with their accounts. It's good.
Yeah, most certainly. And the third category that we see that our investors investing into would be private investments, and most of these would be considered passive investments. So a good portion of our clients, they don't want to necessarily be the ones that are out, looking for the next best deal and hunting and pecking through real estate and sending out flyers and knocking on doors and making calls. So instead, they invest passively with those active investors through sometimes notes and mortgages, but a lot of times through entities like partnership deals or LLC deals where, somebody has sponsored this investment, whether it be an apartment building or a commercial building or, a series of single family homes or whatever it may be. And they've really taken that and they've put it into, some sort of entity that allows passive investors to come in and take advantage of that opportunity. So it's still technically, in the overall scheme of things, maybe a real estate play, but because it's considered passive and because it's wrapped up into a partnership or LLC structure, it falls into a slightly different camp. And we have a good portion of our clients taking advantage of those passive real estate opportunities out there.
Excellent. Do you have any tips that you could share for either someone that's getting started with or considering a self-directed account, or someone maybe that is investing in real estate and they have a friend, an acquaintance that they'd like to expose them to self-directed accounts? What do you, any recommendations to help them to transition or to even allocate some of their portfolio to self-directed accounts?
Absolutely. And when it comes to self-direction, the first thing that you have to decide on, is my knowledge and expertise in investments outside the stock market? And if it is, then I got to say that makes you, a very good candidate for self-direction, because that's really the first part. If your knowledge and experience is really in publicly traded, stocks, bonds, and mutual funds, and self-direction may not really be for you, and that's okay. It's not set up or designed to be for everybody. But once you've kind of made that realization that, hey, I really do know a lot more about this, the second thing from setting up your own account, the thing you've got to look at is, do you want to be active or passive? So I'll use myself, for example. I know significantly more about the real estate market working in this business and space every day for the last 14 years than I do about stocks and bonds. And therefore, I self-direct all of my retirement savings, including my HSA and my ESA for my son. But I don't have the time, here I am at Nuview and I keep a pretty busy schedule. I don't have the time and energy to go out and look through deals and try to find the best properties or investments to do. So I made a decision that self-direction was right for me, but I want to be a passive investor. So I go out and find all the people that are a heck of a lot smarter than me, that know and understand what they're doing in the real estate or related markets, and I invest through them into real estate deals. And so what I get is the exposure and access to investments in real estate that I can see and feel and touch and really get to understand. So I can look at a apartment deal and say, hey, I know where that building is. I know the market. I know the business community around there. I know what kind of tenants are there. I see what the rent rolls look like. I can see what, kind of expenses this. So even though I'm not the one that's finding the deal, I can still underwrite it, if you will, or do my due diligence to make the investment, but I'm passive. And that's a decision that I made. And not everybody makes the same decision. So kind of to recap that is, once you know self-direction is a powerful tool for you, you really have to decide if you want to be active or passive. If you're in the investment world today and you believe that you can help people engage or become investors passively with you or through you, if you're going to take advantage of that, some of the things that to really be aware of is, understanding what that looks like. So, if you're the investor and you're going to be seeking people like me that want to be passive, what is the investment? How are you going to keep me informed? Do you have a track record, that would support, somebody passively investing into you, right? And I'd use you for an example, Denny. If you approached me and said, hey, do you want to invest into this deal? And you've never done a deal yourself, the answer is automatically going to be no, right? Because you're not prepared to take on other people's investments. So you have to make sure that you're ready to be a good steward of other people's money, that you can deliver on anything, that any expectations that you're setting. So if your desire is to use, to be an investor and sponsor, these investments that people can passively invest, and my tips and advice are get your ducks in a row, make sure you understand exactly what you're getting into, because being responsible for your own money is incredibly hard. Being responsible for other people's money is even harder. So, get your house in order, make sure that you're prepared to take on money, make sure that you're underwriting the deals so that everybody wins, and you're not underwriting these deals so that you're the winner and your investors may win. You really need to be prepared to make this a win-win scenario for everybody. And I can tell you, over the last 14 years, I have seen lots and lots of really good investors and really smart people help their friends and family and their circle of influence, provide them opportunities to passively invest into real estate. And it's been very advantageous for the investment sponsor, because they've pulled in some new sources of funds to do more deals. And it's been really advantageous opportunity for the people that are making the investments, because if everything works the way that everyone says that it should work, and everyone does what they say they're going to do, and the market cooperates, we've seen lots and lots of people pull their accounts out of the stock market where they don't feel like they have any knowledge or expertise, and move it passively into the real estate market. And they've been very pleased with the returns and confidence that they have in their ability to continue to generate good returns.
Awesome. And I just to piggyback on what you said there, with if you don't have any experience getting started, you want to sponsor a deal, it's going to be very difficult to get interest from people to invest their hard-earned money with you. Basically that doctor, right? You don't want to be that surgeon that's starting to operate with you, right, for the first time. So maybe a way that I did it and that I recommend for a lot of people is to maybe work with someone that has experience, another sponsor that's done a few deals, and then you can use their credibility and their experience to build yours. And through that process, then you'll not only be better prepared, but you'll have all that deal under your belt that can give you that credibility when you're talking to people.
Absolutely. That's a really good point, Denny. I remember when I first started, I met with a lady, and she's said something that has stuck with me, and I think was a very profound statement. And she said, I learned a long time ago that I won't be the smartest person, in a lot of areas. And so what I've done to be successful in my life is I've simply surrounded myself by all the people that I know are a lot smarter than me in the areas I don't know much about, and it's paid big dividends. And so, to your point, it's the power of a team and the power of surrounding yourself with people that know and understand and can be the experts in a particular area. And if that takes 10 or 15 people to solve it all, great. If you only need 2 or 3 people to kind of know how to proceed forward, that works too. But you got to know what you don't know, and you got to go out and seek the people that can fill in the blanks until you can learn enough to know how to do it yourself. If you ever get that far.
Yep. Well said. That was a very smart woman that gave you that advice. So
absolutely, and a very successful woman.
Very, very. I bet. With closing up, Jason, first I'd like to thank you for spending the time with me today, with us today, and the listeners. I think are getting so much quality of information by all the knowledge that you've been able to share. For those that want to get in touch with you or your company and that want to learn more about self-directed IRAs, can you share your information with them?
Absolutely. And let me start by saying thanks for having me. This was a lot of fun and always good catching up and chatting with you. So if you'd like to reach, I'll kind of give you the company specific, first, and that is Nuview Trust Company. Our website is nuviewtrust.com. You can also reach us via telephone 877-259-3256. Or email info@nuviewtrust.com. And all of those, will provide you information. Certainly our websites, my recommendation is a great place to start. There's some free e-guides and other things that you can download on the website that'll give you a little bit, of a self-study to get acclimated. And then I encourage, as you're progressing forward with your desire to self-direct, certainly pick up the phone. And, there's no such thing as bad questions. They're your questions, and we got a team that's here and standing by, ready to answer them. And, our desire is not to convince you to self-direct. It's simply to help you understand what the opportunities are and what the things you need to be aware of are. And if it makes sense, we'd love to assist you through the process.
Excellent. And then I just wanted to also add, you also do some type of webinars for your clients, and also have events on a quarterly, semi-annually, or annual basis.
We do. Education is the backbone for us. We believe in informing and educating people about self-direction. And so we back that up with a slew of educational opportunities. So we do, and you can get all the information under the events tab on nuviewtrust.com. But we do a variety of events, from both live and webinar-based educational classes on a variety of topics. And we do those, generally weekly or bi-weekly. And then quarterly, we host client events and networking events where we give like-minded people the ability to get together and talk about the things they do and the benefits and opportunities and investments and opportunities that they've come across. And those are a lot of fun, and those are continue to get bigger and bigger and bigger. And almost every time we host one, we end up having to shut down registration shortly after we open it because they've become so popular. And venues can only hold so many people. So those are a lot of fun. But our desire is to make sure that you have every opportunity to understand how self-direction works, and the ways that it may benefit you as a potential investor.
All right. Excellent. Well, without further ado, I'd like to say thank you again, Jason.
Denny, thanks so much. And everybody on the call, thanks for taking the time. Hope you got something out of it.
Thanks for tuning in, everyone. If your head is spinning with all the great information, listen to the podcast again and grab Joe Luby's book. There will be a link on our site. Jason and his company, Nuview IRA, know their stuff. If you are interested in how you can move capital, what the rules are for self-directed IRA accounts, and more, contact him and his office. There are a lot of companies that can help you with this, but if you want personal service and a credible company, I highly recommend Nuview IRA. On our next call, Desi and I talk about the FIRE movement and its money principles. If you have not heard about it, it stands for Financial Independence, Retire Early. A lot of the principles come from a book by Vicki Robin from the 1990s that was recently updated for today's financial atmosphere. We will discuss the book on the call. We will also answer questions like how much money you need to be financially independent, what types of investments to consider, what type of financial mentality do you need to have, and more. If you would like to retire early, are close to retirement, or are already retired, this is a call that you don't want to miss. Now, to learn more about real estate investing or how to be a private investor, visit our website at everythingaboutwealth.com. If you like the show, remember to subscribe to the podcast so you don't miss any episodes we have lined up. Like us on iTunes, Google Play, or your favorite app. This helps more people to find the show. And if you would like to follow us, you can follow Everything About Wealth on Instagram at everythingaboutwealth. And if you're interested to follow us on our personal Instagram, feel free to follow us at Denny, Denny Troncoso, or at Desi Troncoso. With that, we will see you guys on the next show. Take care. Bye-bye.